SoFi just reported earnings and the stock has absolutely destroyed the estimate. It was an amazing, amazing report. I talked about the stock many times, so I have to do an update and let you guys know my opinion on those earnings, which I believe were very, very impressive in my opinion. There are some things I didn't like, so I'm going to tell you some of the risks, some of the things I did like, and give you my updated valuation model on SoFi and let you know why I believe SoFi is still one of the cheapest growth stocks to buy in the stock market at $13.20 per share. It's only up 4% pre-market. I think the stock should be up 5 or 10% on such reports. So I'm going to let you know my opinion, and I hope you enjoy it as always. Now, if you're not familiar with SoFi, SoFi is much more than a bank, but they have many different banking and lending products, I would say, and it's the only company in the United States that has everything you need all within one app. So they have home loans, personal loans, student loans, insurance kind of products, credit cards, savings accounts, checking accounts, retirement accounts, everything you could pretty much need in your life from when you're a student until you're retiring. SoFi has all the products you have. And this is why a lot of members love SoFi. SoFi has over 10.1 million members. They grew members 800,000 over the last 3 months. 800,000. This is insane. We're over 34% year on year, 52% CAGR since 2021. That's a lot of members. So a lot of members are seeing the values that SoFi is offering. Many people, they don't want to go to Bank of America to apply for a loan and to go to another company to service their student loans and then go to another one for a high yield savings account and another one for investments and retirement accounts. They do it all in one app. SoFi is the only one that provides all those products, home loans and everything they could need in their lifetime, all within one app. Now, the main reason why I love this business model so much is because SoFi only has to advertise to you once. So they advertise to you maybe through the SoFi Stadium, maybe through some kind of ad on YouTube, and then you join the SoFi ecosystem for one product. Let's say it's maybe the high yield savings account, okay? Then SoFi can always advertise to you and cross-sell you different products, maybe personal loans, maybe you want to buy a house, it's a home loan, maybe it's something else, and they can cross-sell you all those products for pretty much free. They can only have to advertise to you once you're in the ecosystem, they can cross-sell you thousands of products for pretty much free. And this is how this margin scales over time and margins improve and they get much, much better. And they've been getting much, much better. Net income margin right now is around 9%. This is massive, massive growth. The company used to lose 21% net income margin back in 2021. It was a terrible business model. Now the net income margin is around 9%. This is insane, insane growth from SoFi. Same thing from revenue, guys. Revenue, which what surprised me, has actually reaccelerated. I was like, this is very concerning that SoFi has peaked in revenue growth because the company grew revenue 52%, then 35%, then 26%. I'm like, this one's going to be 20 to 22%. It actually came in at 33%. So the company is re-accelerating in revenue growth. The company is re-accelerating in EBITDA margin. It's now 27%. And everything is pretty much re-accelerating, which is what really shocked me. I was expecting that SoFi has peaked and then it's going to start declining. Well, this quarter has surprised me. SoFi is re-accelerating, and that's amazing from the company. Now, the main thesis with SoFi, I would say, the main kind of thesis if you're trying to invest in the company is you're mainly betting on a fee-based revenue becoming a larger part of the revenue mix. It's right now around 41% of revenues. The CEO eventually wants to take it to 100% of revenues. And the fee-based revenues, I'm going to try to explain it, but you could look at the last 2 deals they signed, and those are massive, massive deals. One of them is a $5 billion agreement with a company called Blue Owl Capital Funds. The second one is a $3.2 billion agreement with Fortress and Edge Focus. But this is what happens pretty much. So before, SoFi was 100% of a bank, okay? So let's say you want a personal loan, and you get the personal loan. SoFi provides you the personal loan. SoFi holds your loan on their balance sheet. They're taking credit risk. If you don't pay the loan, SoFi will be in trouble. And this is not very efficient, and this is not very high margin stuff. Now, as SoFi as a brand, it grew very much. It became a much better platform. People really know SoFi. SoFi is now partnering with companies like Blue Owl Capital. Now, in this case, let's say you want a personal loan. SoFi no longer longer has to hold this personal loan. SoFi no longer has to take the credit risk. Blue Owl Capital will take the credit risk. All SoFi is doing here is pretty much being the middleman. SoFi is advertising to you. They're bringing you into the ecosystem. Now they're going to collect some kind of fees or origination fees for originating this loan. And then they're going to collect service fees whenever you're making your payment every month. So this is going to provide them high margin fee-based recurring revenues, and that's ultimately going to give the company higher margins and a much higher multiple expansion than where the company is trading at, or maybe no multiple contraction is going to stay at a very elevated multiple as the fee-based revenues continues to make more and more shares a higher and higher percentage of total revenues. And this is the main thesis with SoFi, and it's such a beautiful thing because they don't really have to hold them on the balance sheet. They're not taking the kind of credit risks they used to take. Other companies are taking the credit risk. SoFi collects origination fees and service fees whenever you are paying your loan. And it is such an amazing, amazing business model. Okay. Now, one of the things that hasn't been going too well is a technology platform. So tech platform, which I believe is, whatever, they kind of provide a platform for other companies in terms of UI and other kind of things to run their operations for certain banks and certain other things. It hasn't been going too well, and profits and margin contributions have been declining, but the company has signed some deals. I believe one of them is with the government, I believe, with Treasury for debit cards or something. So it's likely going to get a little bit better, but so far it hasn't really been going too well. But it's one of the smallest parts of SoFi's revenues. Now, what I really like about the company is mainly the CEO. The CEO, Anthony Noto, is such an amazing, amazing CEO. People have been slashing on him lately, which I'm going to talk about. But he is an amazing CEO, and he has a good track record of setting low expectations so he could beat on them. This is very well known. Everyone knows that this is his trick. And I talked about it in the last video I made. Now, in 2024, for example, the company has guided 7 or 8 cents in the first quarter. The stock went down. Then the stock ended up with 15 cents in earnings per share, almost double original guidance. Now, do you really believe the CEO was so dumb that he didn't see, final results doubling guidance? Of course he did, but he likes to set low expectations so he could beat, and that really helps the stock and helps investors in general. And I said he's going to do the same thing this year. Now, in Q4 of 2025, he set up guidance for 2020. In Q4 of 2024, he set guidance for 2025. It was lower than expected, and our stock went down. I told people, but he's doing the same thing. And I believe he's still doing the same thing because this quarter, he raised guidance from 25 to 27 cents for full year to 27 to 28 cents. Now, I believe he's going to do the same thing in Q2 and Q3 and even Q4. And he's likely going to end with 30 to 32, maybe 35 cents of earnings per share. It's going to surprise the market, and the stock will be much, much higher. And he kind of, knows this trick. I mean, he really pays attention, to the stock and what will let the stock trade at a higher multiple. And this is why whenever he was talking about the fee-based revenue, he said the stock will get a multiple expansion if we have a higher percentage of our revenues as fee-based revenues, because we're taking less credit risk. So he really pays attention to that stuff, very shareholder friendly. And this is just amazing from the company. Okay. Now, if we look at the company's guidance for 2026, they said we remain confident in delivering the 2026 earnings per share in the range of 55 cents to 80 cents per share. Moreover, we are well positioned to deliver 20 to 25% annual earnings per share growth beyond 2026. So this is massive, massive growth, and they're still confident in the 55 cents to 80 cents per share, which is amazing, amazing from the company. Now, if we do just a quick calculation just to show you something, okay, and we take the 80 cents in earnings per share because the company always beats on that stuff and they always too conservative. So if they do reach 80 cents in 2026, even if it takes them to 2027, okay, let's just assume it takes them to 2027. Now, if they reach 80 cents per share by 2027 and the company is growing 25% earnings per share, they trade around double that with higher margins, which is around 40p. I believe 40p is fair. Now, if we time it by 40p, this is $32 per share. The stock right now is trading around $13 and I believe 30 cents per share. This is over 140% on the upside in like 2 years, and it could be even as soon as later next year. This is insane upside, for a company like SoFi. Even if it takes them to 2028, this is 140% in what is it, 3 years? This is an amazing return, with a company like SoFi. So while the stock might look expensive at 50 PE, the company is growing those earnings around 75% in 2023, 282% in 2024, 73% in 2025, and are expected to grow 75% in 2026. So you're paying less than one time PEG ratio or less than one time price to earnings growth. And this is really cheap for the stock. Even if they don't achieve 80 cents, if they achieve 60, 65 cents, the stock is still cheap. So I really like it very, very much. But there are some risks with the company that people highlight, and I have to address them, so to help kind of, the comment section, because I know what I'm going to get. And the first one is a recession. People are worried. What if we have a recession? SoFi could go to zero. SoFi could go down, I don't know, 70 or 80%. Well, there's a few things with SoFi. Okay, the first one, right now, 41% of their revenues are fee-based. So this is 41% less credit risk than what they used to hold. But the second one is most of SoFi's customers are good with their finances. I mean, that's what it looks like. And I said our personal loan borrowers have a weighted average income of 158,000 and a weighted average FICO score of 744, while our student loan borrowers have a weighted average income of 134,000 with a weighted average FICO score of 765. So this is really not bad. I mean, 158,000, 765, it's really not bad at all. So their consumers are much better prepared to weather the storm. And I don't believe the recession is going to really affect SoFi as much as people believe. Now, the second one, which is a major one with many people, is Robinhood. People keep comparing SoFi to Robinhood, and they believe that Robinhood is everything that SoFi has promised and SoFi hasn't delivered. And they're giving the CEO a hard time on X, and he even replied to some people, and he told them, I read every single comment you guys give me, and I'm working on it. Like just be patient, But the only thing I would say is you can't really compare SoFi and Robinhood, because SoFi is mainly a leader in lending. Robinhood has yet to enter the lending space. And let's assume Robinhood does enter the lending space, that there's so much room for so many different players. We have trillions and trillions of dollars in this economy. There's trillions and trillions of dollars sitting in traditional banks, Bank of America, Wells Fargo, all those companies, SoFi, Robinhood, all these kind of fintech stocks, they are disrupting, more than $1 trillion industry of traditional banks that allow, younger people, they don't want to go to all those banks. They don't want to go to a branch. They don't want to do all that stuff. They want something that's easy on the internet, all in one app. They want to do it very simple, very easily. SoFi provides that, and maybe Robinhood someday will provide it. And I believe there is a place for SoFi and Robinhood. It's not like if Robinhood is doing it, that means SoFi is going to zero. But this is the kind of drama that people like to put up on something, because Robinhood stock has outperformed SoFi stock, so there has to be a reason, and people try to rationalize it. But I believe it's really not smart at all to just compare SoFi to Robinhood and to believe that if Robinhood is doing something, that means there's no place for SoFi. I mean, that's really dumb in my opinion. Again, just my opinion here. But the last one, which is the biggest one, not the biggest one, but it's a major one, it's mainly stock-based compensation, because all the numbers we talked about are non-GAAP, and a good chunk of it is in stock-based compensation. But as net income, as revenues have been increasing, so SoFi's stock-based compensation expense every single quarter has been pretty much going down. I mean, it peaked around 80 million, now it's around 66. It's been, on a steadily going down. And I believe it's going to keep going down as a percentage of free cash flow and as a percentage of net income over time. For now, it is still elevated. It's causing some share dilution, of course. But again, this is how it is with a lot of those early stage companies, or you say growth companies in their early stage. This is how it starts. And then as the company gets more profitable, it gets more mature, they eventually start buying back stock. But in the near term, you're going to have some dilution, and you're going to have some stock-based compensation. And that's what comes with the risk of owning a growth stock like SoFi, like Robinhood, like HIMS, and like Palantir, like many of those stocks. They pretty much have the same story. So this is all I wanted to say about SoFi. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.